Question 1. Investigation of the potential impact of a new anti-money laundering directive on the Bank of China's operations requires a comprehensive approach. Which of the following methodologies best aligns with regulatory expectations for a thorough impact assessment? Option A. Conducting a detailed analysis of how the directive affects customer onboarding processes, transaction monitoring systems, and suspicious activity reporting mechanisms, involving input from relevant business units and technology teams. Option B. Relying on the compliance department to interpret the directive and provide a summary of key changes to other departments as they arise. Option C. Waiting for the directive to be fully implemented and then assessing any immediate operational issues that emerge. Option D. Performing a quick review of the directive's main points and assuming that existing controls will be sufficient without further investigation. The correct answer is A. Conducting a detailed analysis of how the directive affects customer onboarding processes, transaction monitoring systems, and suspicious activity reporting mechanisms, involving input from relevant business units and technology teams. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent uncertainty in predicting the full impact of a new regulatory change on a complex financial institution like the Bank of China. The challenge lies in balancing proactive risk management with the need for accurate and timely information, while also considering the potential for unintended consequences. A superficial assessment could lead to misallocation of resources, inadequate preparedness, or even regulatory non-compliance. Careful judgment is required to identify key areas of impact, assess the magnitude of potential changes, and develop appropriate mitigation strategies. Correct approach analysis. The correct approach involves a systematic and comprehensive impact assessment that considers multiple facets of the bank's operations. This includes evaluating the direct and indirect effects on business lines, financial reporting, IT systems, operational processes, and human resources. It necessitates engagement with relevant stakeholders across the organization to gather diverse perspectives and ensure all potential impacts are identified. This thoroughness is crucial for adhering to regulatory expectations, which often mandate that financial institutions understand and manage the implications of new rules. By adopting a holistic view, the bank can proactively identify risks, develop robust compliance plans, and ensure business continuity, thereby demonstrating responsible corporate governance and a commitment to regulatory adherence. This aligns with the principles of sound risk management and proactive compliance expected of major financial institutions. Incorrect approaches analysis. One incorrect approach would be to focus solely on the immediate, obvious changes to a single department, such as compliance. This is professionally unacceptable because it ignores the ripple effects across the entire organization. Regulatory changes rarely impact just one area. They often have cascading effects on operations, technology, and financial reporting. This narrow focus risks overlooking significant compliance gaps and operational disruptions, leading to potential regulatory breaches and financial losses. Another incorrect approach would be to delay the assessment until the regulation is fully implemented, relying on external guidance to dictate internal actions. This is professionally unacceptable as it demonstrates a lack of proactive risk management and a reactive stance towards compliance. Regulators expect institutions to anticipate and prepare for changes, not simply react to them. Such a delay can result in rushed, ineffective implementation, increased risk of non-compliance, and potential penalties. It also fails to leverage internal expertise and understanding of the bank's specific context. A third incorrect approach would be to conduct a superficial assessment based on anecdotal evidence or the opinions of a few senior managers without rigorous data collection or analysis. This is professionally unacceptable because it lacks the necessary diligence and objectivity required for a credible impact assessment. Decisions based on assumptions rather than evidence are prone to error and can lead to significant misjudgments about the true impact of the regulation. This approach undermines the integrity of the risk management framework and can expose the bank to unforeseen risks. Professional reasoning. Professionals should adopt a structured, multidisciplinary approach to impact assessment. This involves 1. Defining the scope of the assessment clearly, identifying all relevant regulatory provisions. 2. Establishing a cross-functional working group with representatives from legal, compliance, business units, IT, and operation. 3. Developing a detailed methodology for identifying and evaluating impacts, including data collection and analysis. 4. Engaging with stakeholders to gather input and validate findings. 5. Documenting the assessment process and its outcomes thoroughly. 6. Developing a clear action plan to address identified impacts, including timelines, responsibilities, and resource allocation. 7. Establishing a process for ongoing monitoring and review to ensure continued compliance and adaptation. This systematic process ensures that all potential impacts are considered, risks are adequately managed, and the bank remains compliant with its regulatory obligations. Question 2. What factors determine the appropriate level of due diligence required for onboarding a new corporate client at the Bank of China, considering the regulatory framework of the People's Bank of China and the China Banking and Insurance Regulatory Commission? Option A. The client's stated business activities, ownership structure, geographic locations of operation, and the perceived risk of their transactions. Option B. The client's ability to provide a large initial deposit and their potential for future business volume. Option C. The industry in which the client operates, assuming all industries carry similar inherent risks. Option D. The speed at which the client can complete the onboarding paperwork and their willingness to sign standard bank agreements. The correct answer is A. The client's stated business activities, ownership structure, geographic locations of operation, and the perceived risk of their transactions. Explanation. Scenario analysis. This scenario is professionally challenging because it requires balancing the Bank of China's internal risk appetite framework with the specific regulatory requirements of the People's Bank of China, PBOC, and the China Banking and Insurance Regulatory Commission, CBIRC, concerning anti-money laundering (AML) and counter-terrorist financing, CTF. The pressure to onboard new clients quickly for business growth can create a conflict with the thorough due diligence mandated by regulations. A failure to adequately assess and mitigate risks associated with a new corporate client could expose the bank to significant financial penalties, reputational damage, and regulatory sanctions. The complexity arises from interpreting and applying broad regulatory principles to a specific, potentially high-risk client profile. Correct approach analysis. The correct approach involves a comprehensive risk-based assessment that aligns with the Bank of China's internal AML/CTF policies, which are themselves designed to comply with PBOC and CBIRC regulations. This means going beyond superficial checks to understand the client's business model, ownership structure, geographic exposure, and the nature of their transactions. It requires obtaining and verifying robust Know Your Customer (KIC) documentation, including beneficial ownership information, and assessing the potential for the client to be involved in illicit activities. If red flags are identified, further enhanced due diligence measures must be implemented, potentially including seeking additional information from the client, consulting external databases, or even declining to onboard the client if the risks cannot be adequately mitigated. This approach ensures compliance with regulatory obligations to prevent financial crime and upholds the bank's ethical responsibility to maintain the integrity of the financial system. Incorrect approach is analysis. One incorrect approach is to rely solely on the client's self-declaration of their business activities and ownership without independent verification. This fails to meet the regulatory requirement for the bank to conduct its own due diligence and risk assessment. It creates a significant regulatory failure by not actively seeking to understand and verify the information provided, leaving the bank vulnerable to being used for money laundering or terrorist financing. Ethically, it represents a dereliction of duty to protect the financial system. Another incorrect approach is to prioritize speed of onboarding over thorough risk assessment due to business development targets. This directly contravenes the risk-based approach mandated by PBOC and CBIRC regulations, which emphasize that the level of due diligence should be commensurate with the identified risks. Prioritizing speed over risk assessment is a regulatory failure, as it bypasses critical controls designed to prevent financial crime. It also demonstrates poor professional judgment by allowing commercial pressures to override regulatory and ethical imperatives. A third incorrect approach is to assume that a client operating in a seemingly low-risk industry is automatically low-risk, without considering other risk factors, such as their geographic locations of operation or the source of their funds. Regulations require a holistic risk assessment that considers multiple dimensions of risk, not just industry type. Failing to do so is a regulatory failure because it leads to an incomplete risk profile and potentially inadequate controls. It also represents a lack of professional diligence in understanding the full spectrum of risks associated with a client. Professional reasoning. Professionals should adopt a systematic, risk-based approach to client onboarding. This involves 1. Understanding the regulatory landscape. Familiarize oneself with the latest AML/CTF regulations from the PBOC and CBERC, as well as the Bank of China's internal policies. 2. Conducting thorough KYC. Collect and verify all necessary customer identification and beneficial ownership information. 3. Performing a risk assessment. Evaluate the client's business, ownership, geographic exposure, and transaction patterns to determine their risk level. 4. Implementing appropriate controls. Apply standard due diligence or enhanced due diligence measures based on the assessed risk level. 5. Documenting the process. Maintain clear and comprehensive records of all due diligence activities and decisions. 6. Escalating concerns. If any red flags or uncertainties arise, escalate them to the appropriate compliance or risk management personnel for further review and decision-making. This structured process ensures that regulatory obligations are met, risks are effectively managed, and the bank's integrity is preserved. Question 3. When evaluating potential process optimization initiatives within the Bank of China's retail banking operations, which of the following approaches best balances efficiency gains with regulatory compliance and risk management? Option A. Prioritizing the adoption of new technologies that promise significant efficiency improvements, assuming they are generally compliant with industry standards. Option B. Conducting a thorough impact assessment that analyzes the effects of proposed changes on regulatory adherence, internal controls, and operational risk, alongside efficiency benefits, before any implementation. Option C. Implementing changes that demonstrably reduce operational costs and processing times, with a secondary review of compliance implications post-implementation. Option D. Focusing on streamlining customer-facing processes to enhance customer satisfaction, with minimal disruption to existing back-office compliance procedures. The correct answer is C. Implementing changes that demonstrably reduce operational costs and processing times, with a secondary review of compliance implications post-implementation. Explanation. This scenario is professionally challenging because it requires balancing the immediate need for efficiency with the long-term implications of process changes on compliance and risk management within a regulated financial institution like the Bank of China. The pressure to optimize processes can sometimes lead to shortcuts that inadvertently increase operational or regulatory risk. Careful judgment is required to ensure that efficiency gains do not compromise the integrity of internal controls or adherence to the Bank of China's internal policies and relevant Chinese financial regulations. The correct approach represents best professional practice because it prioritizes a comprehensive review that includes impact assessments on compliance, risk, and stakeholder feedback before implementation. This aligns with the Bank of China's commitment to robust internal governance and regulatory adherence, as mandated by the People's Bank of China, PBOC, and the China Banking and Insurance Regulatory Commission, CBERC, guidelines. Such a methodical approach ensures that process optimization is sustainable, minimizes unintended consequences, and maintains the bank's reputation and operational stability. An incorrect approach that focuses solely on cost reduction, without considering the downstream effects on compliance, would be professionally unacceptable. This could lead to violations of internal control frameworks designed to prevent fraud, money laundering, or operational errors, potentially resulting in regulatory penalties, reputational damage, and financial losses. Another incorrect approach that bypasses necessary stakeholder consultations, such as with the compliance or risk departments, fails to leverage crucial expertise, and can lead to the implementation of flawed processes that create new vulnerabilities. This disregards the principle of shared responsibility for risk management and compliance within the organization. Professionals should employ a decision-making framework that begins with clearly defining the objectives of process optimization. This should be followed by a thorough analysis of the current process, identification of bottlenecks, and brainstorming of potential solutions. Crucially, each proposed solution must undergo a rigorous assessment of its impact on efficiency, cost, risk, and compliance. Engaging relevant stakeholders, including those in compliance, risk management, IT, and affected business units, is essential for gathering diverse perspectives and ensuring buy-in. Pilot testing and phased implementation, coupled with continuous monitoring and feedback loops, are vital for successful and compliant process optimization. Question 4. The audit findings indicate significant delays and errors in the customer onboarding process, leading to increased operational costs and potential compliance risks. Which of the following approaches best addresses these findings while adhering to the Bank of China's operational and regulatory framework? Option A. Immediately implement a new, unproven software solution recommended by a vendor, bypassing internal testing and approval protocols to expedite the fix. Option B. Focus on retraining existing staff on current procedures without investigating the underlying process design flaws that may be contributing to the errors. Option C. Conduct a comprehensive root cause analysis of the onboarding process, involving key stakeholders from operations, compliance, and IT, to identify systemic issues and develop data-driven, sustainable solutions. Option D. Delegate the entire process redesign and implementation to an external consulting firm, with minimal internal involvement or oversight. The correct answer is C. Conduct a comprehensive root cause analysis of the onboarding process, involving key stakeholders from operations, compliance, and IT, to identify systemic issues and develop data-driven, sustainable solutions. Explanation. Scenario analysis. This scenario presents a common challenge in financial institutions where audit findings highlight inefficiencies in a critical operational process. The challenge lies in balancing the need for immediate remediation with the long-term strategic goals of process optimization, all while adhering to the stringent regulatory environment of the Bank of China. The pressure to demonstrate tangible improvements quickly can lead to short-sighted solutions that may not be sustainable or compliant. Correct approach analysis. The correct approach involves a comprehensive, data-driven analysis of the root causes of the identified inefficiencies. This aligns with the Bank of China's commitment to operational excellence and regulatory compliance, as mandated by the People's Bank of China, PBOC, and other relevant financial regulations. A thorough root cause analysis ensures that solutions address the fundamental issues rather than just the symptoms, leading to sustainable improvements. This methodical approach also facilitates better risk management by identifying and mitigating underlying process weaknesses, which is a key expectation for financial institutions. Furthermore, involving stakeholders ensures buy-in and facilitates the successful implementation of optimized processes, a principle often emphasized in internal control frameworks. Incorrect approaches analysis. One incorrect approach focuses solely on implementing a quick fix without understanding the underlying issues. This is professionally unacceptable because it risks creating new inefficiencies or failing to address the core problem, potentially leading to recurring audit findings and a lack of genuine process improvement. From a regulatory perspective, it demonstrates a superficial engagement with compliance and risk management, which could be viewed as a failure to uphold due diligence. Another incorrect approach involves bypassing established internal procedures for change management and approval. This is a significant regulatory and ethical failure. The Bank of China operates under strict internal governance and external regulatory oversight. Deviating from these procedures can lead to unauthorized changes, increased operational risk, and potential noncompliance with internal policies and external regulations governing operational changes. It undermines the control environment and can have serious consequences for the bank's stability and reputation. A third incorrect approach is to delegate the entire optimization effort to an external consultant without sufficient internal oversight or knowledge transfer. While external expertise can be valuable, relying solely on it without internal engagement can lead to solutions that are not tailored to the bank's specific context, culture, or long-term strategic objectives. It also fails to build internal capacity for continuous improvement, which is a critical aspect of operational resilience and regulatory expectation. Ethically, it can be seen as an abdication of responsibility for managing critical business processes. Professional reasoning. Professionals facing such audit findings should adopt a structured problem-solving methodology. This involves 1. Acknowledging and understanding the audit findings. 2. Initiating a thorough root cause analysis, utilizing data and involving relevant subject matter experts. 3. Developing a range of potential solutions, evaluating them against criteria such as effectiveness, efficiency, cost, risk, and regulatory compliance. 4. Selecting the most appropriate solution based on this evaluation. 5. Developing a detailed implementation plan, including stakeholder engagement and change management. 6. Monitoring the implemented solution to ensure sustained effectiveness and compliance. This systematic approach ensures that decisions are informed, defensible, and aligned with both operational goals and regulatory requirements. Question 5. Governance review demonstrates that the new digital customer onboarding system at Bank of China has been developed with advanced features aimed at streamlining the application process. However, concerns have been raised regarding the system's adherence to the latest directives on customer due diligence, CDD, and data protection, particularly in how it handles identity verification for remote applicants. What is the most prudent approach to ensure full regulatory compliance before the system's widespread deployment? Option A. Proceed with a phased rollout, closely monitoring customer feedback and addressing any identified compliance issues as they arise post-launch. Option B. Rely on the vendor's certification of compliance with relevant regulations, assuming their internal processes are sufficient to meet Bank of China's requirements. Option C. Implement the system immediately to gain a competitive advantage, with a plan to conduct a full compliance audit within the next 6 months. Option D. Conduct comprehensive pre-launch testing and validation of the system's CDD and data protection functionalities against all relevant Bank of China regulations, and obtain independent assurance of compliance before full deployment. The correct answer is A. Proceed with a phased rollout, closely monitoring customer feedback and addressing any identified compliance issues as they arise post-launch. Explanation. Scenario analysis. This scenario presents a professional challenge stemming from the inherent tension between achieving business objectives and adhering to stringent regulatory requirements. The implementation of a new digital onboarding system, while intended to enhance efficiency and customer experience, introduces potential risks related to data privacy and customer identification, which are paramount under Bank of China's regulatory framework. The challenge lies in balancing the speed of innovation with the imperative of robust compliance, requiring careful judgment to ensure that technological advancements do not inadvertently create vulnerabilities or breaches of regulatory mandates. Correct approach analysis. The correct approach emphasizes a phased implementation with rigorous pre-launch testing and validation against specific Bank of China regulations concerning customer due diligence, CDD, and data protection. This aligns with the principle of compliance by design, where regulatory adherence is integrated into the system development lifecycle from the outset. It demonstrates best professional practice by proactively identifying and mitigating risks before full deployment, ensuring that the system meets all legal and regulatory obligations, thereby safeguarding the bank and its customers. This approach reflects the Bank of China's commitment to maintaining a secure and compliant operational environment, as mandated by relevant banking laws and directives. Incorrect approaches analysis. One incorrect approach involves prioritizing rapid deployment over comprehensive testing. This would constitute a significant regulatory failure, as it bypasses essential checks for compliance with CDD requirements and data privacy laws. Such an approach risks exposing the bank to penalties, reputational damage, and potential data breaches, directly contravening the Bank of China's regulatory obligations to protect customer information and ensure accurate identification. Another incorrect approach might be to rely solely on vendor assurances regarding compliance without independent verification. This is a failure of due diligence and oversight. The Bank of China has a responsibility to ensure its systems, whether developed in-house or by third parties, meet all regulatory standards. Delegating this responsibility without proper validation is a breach of internal governance and external regulatory expectations. A third incorrect approach could be to implement the system with known, unaddressed compliance gaps, intending to rectify them post-launch. This is ethically and regulatorily unacceptable. It demonstrates a disregard for the immediate impact of non-compliance and exposes the bank to immediate risks. The Bank of China's regulatory framework demands proactive adherence, not retrospective correction of fundamental compliance issues. Professional reasoning. Professionals facing such implementation challenges should adopt a structured decision-making process. This involves 1. Thoroughly understanding the relevant Bank of China regulations pertaining to digital onboarding, data privacy, and customer identification. 2. Conducting a comprehensive risk assessment of the new system, identifying potential compliance gaps. 3. prioritizing mitigation strategies that align with regulatory requirements and business objectives. 4. Implementing a phased rollout with robust testing and validation at each stage. 5. Establishing clear escalation paths for any identified compliance issues. 6. Maintaining detailed documentation of the entire process for audit and review purposes. This systematic approach ensures that innovation is pursued responsibly and within the bounds of regulatory compliance. Question 6. Market research demonstrates a significant opportunity to enhance customer service and operational efficiency by implementing a new AI-powered digital platform for wealth management advisory services. The vendor claims the platform is fully compliant with international best practices for AI and data security. However, internal IT and risk assessment teams have identified potential, though not fully quantified, risks related to data privacy and algorithmic bias that have not yet been fully mitigated. Given the Bank of China's stringent regulatory environment, what is the most prudent approach to introducing this new platform? Option A. Initiate a limited pilot program in a controlled environment to thoroughly test the platform's functionality, security, and compliance with Bank of China regulations, gathering data to refine risk mitigation strategies before a full rollout. Option B. Implement the platform immediately but allocate additional resources to address identified risks and vulnerabilities on an ongoing basis after the initial launch. Option C. Deploy the platform only after the vendor provides a formal certification of compliance with all relevant Chinese financial regulations, even if this significantly delays market entry. Option D. Proceed with immediate full-scale deployment across all customer segments to capitalize on the market opportunity and gain a competitive advantage, relying on the vendor's assurances of compliance. The correct answer is A. Initiate a limited pilot program in a controlled environment to thoroughly test the platform's functionality, security, and compliance with Bank of China regulations, gathering data to refine risk mitigation strategies before a full rollout. Explanation. Scenario analysis. This scenario presents a common challenge in financial institutions where the drive for innovation and market competitiveness can sometimes clash with established risk management protocols and regulatory compliance. The implementation of a new digital platform, while offering potential benefits, introduces novel risks that may not be fully understood or adequately controlled by existing frameworks. The challenge lies in balancing the strategic imperative to adopt new technologies with the fundamental responsibility to protect client assets, maintain market integrity, and adhere to the Bank of China's stringent regulatory obligations. This requires a nuanced approach that prioritizes robust risk assessment and control before full-scale deployment. Correct approach analysis. The correct approach emphasizes a phased implementation strategy, starting with a pilot program. This aligns with best practices in risk management and regulatory compliance for new technology adoption. A pilot allows for controlled testing of the platform's functionality, security, and operational resilience in a live, albeit limited, environment. This enables the identification and mitigation of unforeseen issues, such as data integrity breaches, system vulnerabilities, or customer experience problems, before they impact the entire client base. Crucially, this approach allows the bank to gather real-world data to validate risk assessments and ensure compliance with relevant Bank of China regulations concerning data security, customer protection, and operational risk management. It demonstrates a proactive and responsible approach to innovation, prioritizing client safety and regulatory adherence. Incorrect approaches analysis. One incorrect approach involves immediate full-scale deployment without adequate testing. This directly contravenes the principle of prudent risk management and could lead to significant operational failures, financial losses, and reputational damage. From a regulatory perspective, it risks violating directives from the People's Bank of China, PBOC, and the China Banking and Insurance Regulatory Commission, CBIRC, that mandate robust risk controls and consumer protection measures for new financial products and services. Another incorrect approach is to rely solely on vendor assurances regarding the platform's security and compliance. While vendor due diligence is important, the ultimate responsibility for regulatory compliance and risk management rests with the bank. Over-reliance on third-party claims without independent verification exposes the bank to significant regulatory scrutiny and potential penalties if the platform fails to meet Chinese regulatory standards. This could be seen as a failure to exercise due diligence as required by banking regulations. A third incorrect approach is to proceed with implementation while acknowledging significant, unaddressed security vulnerabilities. This is ethically and regulatorily unacceptable. It demonstrates a disregard for client data protection and the integrity of financial operations, directly violating principles of sound banking practice and potentially contravening specific data protection laws and cybersecurity regulations enforced by Chinese authorities. Professional reasoning. Professionals facing such a decision should adopt a structured risk-based approach. This involves 1. Thoroughly understanding the proposed innovation and its potential benefits and risks. 2. Conducting comprehensive risk assessments, including operational, cybersecurity, legal, and compliance risks, in the context of Bank of China's regulatory environment. 3. Developing and implementing robust control measures to mitigate identified risks. 4. Prioritizing phased implementation and pilot testing to validate controls and gather data. 5. Ensuring continuous monitoring and adaptation of controls post-deployment. This systematic process ensures that innovation is pursued responsibly, safeguarding client interests and maintaining regulatory compliance. Question 7. Benchmark analysis indicates that a Bank of China relationship manager has discovered a potential conflict of interest when a client's spouse, who is also a client of the bank, requests access to specific financial details of the first client's account to assist with a family financial matter. The relationship manager is aware that the first client has not explicitly authorized such disclosure. Considering the Bank of China's internal policies and the regulatory framework of the People's Bank of China, PBOC, concerning client confidentiality and conflict of interest management, what is the most appropriate course of action for the relationship manager? Option A. Inform the client's spouse that the information cannot be shared due to confidentiality policies, but offer to relay a general message to the first client about the spouse's request. Option B. Proceed to assist the client's spouse by sharing the requested financial details, assuming that familial relationships imply consent for information sharing. Option C. Immediately escalate the situation to the bank's compliance department or supervisor for guidance and to initiate the formal conflict resolution process. Option D. Independently decide to share only the minimum necessary information with the client's spouse to resolve the immediate family financial issue without informing management. The correct answer is C. Immediately escalate the situation to the bank's compliance department or supervisor for guidance and to initiate the formal conflict resolution process. Explanation. Scenario analysis. This scenario presents a professional challenge in navigating the Bank of China's internal policies and external regulatory requirements concerning the handling of sensitive client information when a potential conflict of interest arises. The core difficulty lies in balancing the need for efficient client service with the imperative to maintain confidentiality and avoid any perception or reality of impropriety. A banker must exercise sound judgment to protect both the client's interests and the bank's reputation, adhering strictly to the Bank of China's Code of Conduct and relevant People's Bank of China, PBOC, regulations. Correct approach analysis. The correct approach involves immediately escalating the situation to the relevant compliance department or supervisor. This aligns with best professional practice as it ensures that the potential conflict of interest is formally recognized and managed by those with the authority and expertise to do so. It upholds the principles of integrity and transparency mandated by the Bank of China's internal policies and PBOC guidelines, which emphasize reporting any situation that could compromise client confidentiality or create a conflict. This proactive reporting prevents unauthorized access to information and allows for a structured resolution, such as reassigning the client or implementing strict information sharing protocols, thereby safeguarding client data and maintaining trust. Incorrect approaches analysis. Proceeding to assist the client without disclosure or consultation represents a significant ethical and regulatory failure. It violates the duty of confidentiality owed to all clients and creates a direct conflict of interest, potentially leading to the misuse of sensitive information. This action contravenes the Bank of China's Code of Conduct and PBOC regulations on data privacy and conflict of interest management. Attempting to manage the situation independently by only sharing information with the client's spouse, without informing superiors or compliance, is also professionally unacceptable. While seemingly an attempt to resolve the issue, it bypasses established internal controls and reporting mechanisms. This approach risks misinterpreting the scope of permissible information sharing and could inadvertently breach confidentiality or create further conflicts, failing to adhere to the Bank of China's strict protocols for handling sensitive client data and conflicts of interest. Sharing the information with the client's spouse under the guise of helping a friend, without proper authorization or adherence to internal procedures, is a severe breach of professional ethics and regulatory compliance. It disregards the formal channels for conflict resolution and information disclosure, potentially exposing the bank to legal repercussions and reputational damage. This action directly violates the principles of client data protection and the Bank of China's stringent policies on handling sensitive information. Professional reasoning. Professionals in banking must adopt a decision-making process that prioritizes adherence to regulatory frameworks and ethical codes. When faced with a potential conflict of interest or a situation involving sensitive client information, the primary step should always be to consult internal policies and escalate the matter to the appropriate compliance or supervisory authority. This ensures that all actions are taken within the bounds of the law and the bank's ethical standards, protecting client interests and the institution's integrity. A proactive and transparent approach to conflict resolution is paramount. Question 8. Risk assessment procedures indicate that a long-standing, high-net-worth client has recently begun conducting a series of unusual cash deposits and withdrawals that do not align with their typical business profile. The client has also become evasive when asked for clarification on the source of funds. As an employee of Bank of China, what is the most appropriate immediate course of action? Option A. Directly confront the client about the suspicious nature of their transactions and demand an explanation. Option B. Escalate the matter to the bank's compliance department or AML reporting unit for further investigation and guidance. Option C. Continue processing the client's transactions as usual while discreetly trying to gather more information from the client. Option D. Ignore the unusual activity, assuming it is a temporary anomaly and not a cause for concern. The correct answer is B. Escalate the matter to the bank's compliance department or AML reporting unit for further investigation and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. The employee must navigate the delicate balance of maintaining client trust while adhering to anti-money laundering (AML) regulations. The pressure to retain a high-value client can create a temptation to overlook or downplay potential red flags, making objective judgment crucial. Correct approach analysis. The correct approach involves escalating the matter internally to the designated compliance officer or AML reporting unit. This aligns with the Bank of China's internal policies and procedures, which are designed to comply with the People's Bank of China (PBOC) AML regulations. The PBOC mandates that financial institutions establish robust AML systems and controls, including clear reporting lines for suspicious transactions. By escalating, the employee fulfills their individual responsibility to report, while allowing the specialized compliance team to conduct a thorough investigation and determine the appropriate course of action, which may include filing a suspicious transaction report (STR) with the relevant authorities. This process ensures that the bank acts in accordance with its legal obligations and maintains its integrity. Incorrect approaches analysis. Failing to report the suspicious activity and continuing to process transactions for the client is a direct violation of AML regulations. This inaction can lead to severe penalties for both the individual and the bank, including fines and reputational damage. It also exposes the bank to the risk of being used for illicit purposes. Attempting to discreetly gather more information from the client without reporting the initial suspicion is problematic. While further information might be helpful, it can be construed as tipping off the client, which is a serious offense under AML laws. Furthermore, it delays the mandatory reporting timeline and potentially compromises the integrity of any subsequent investigation. Directly confronting the client with suspicions without following the established internal reporting protocol is also a failure. This approach bypasses the bank's compliance framework, could lead to the destruction of evidence, and may put the employee in a compromising or even dangerous situation. It also undermines the authority and role of the compliance department. Professional reasoning. professionals should adopt a framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Recognizing potential red flags based on training and experience. 2. Understanding and adhering to internal reporting procedures. 3. Escalating concerns promptly to the appropriate internal authority, e.g., compliance department. 4. Avoiding any actions that could be interpreted as tipping off a client. 5. Documenting all actions taken and observations made. This systematic approach ensures that regulatory obligations are met, the bank's risk is managed, and ethical standards are upheld. Question 9. Strategic planning requires a proactive approach to integrating regulatory compliance into new business initiatives. A new employee at Bank of China proposes a novel cross-border transaction service that promises significant revenue growth. However, the proposed mechanism for customer onboarding and transaction monitoring appears to bypass some of the more stringent checks typically associated with international financial flows. Which of the following actions best reflects the appropriate regulatory compliance approach for Bank of China in this situation? Option A. Allow the business development team to proceed with the service, as they are best positioned to assess its market viability and operational feasibility. Option B. Conduct a comprehensive review of the proposed service by the Bank of China's Compliance Department to ensure full adherence to the People's Bank of China's anti-money laundering and know your customer regulations before any implementation. Option C. Immediately approve the new service for launch, given its potential to significantly boost revenue and the employees' enthusiasm for driving business growth. Option D. Reject the proposed service outright without further investigation, citing the employees' lack of experience in international banking regulations. Correct answer is B. Conduct a comprehensive review of the proposed service by the Bank of China's Compliance Department to ensure full adherence to the People's Bank of China's anti-money laundering and know your customer regulations before any implementation. Explanation. Scenario analysis. This scenario presents a professional challenge where a new employee, eager to impress, proposes a strategy that, while potentially profitable, carries significant regulatory risk. The challenge lies in balancing business objectives with strict adherence to the Bank of China's regulatory framework, specifically concerning anti-money laundering (AML) and know your customer (KIC) obligations. The new employee's lack of experience and potential overenthusiasm necessitate careful guidance and a robust compliance review process. Correct approach analysis. The correct approach involves a thorough review of the proposed strategy by the Compliance Department, ensuring it aligns with the People's Bank of China (PBOC) regulations and internal Bank of China policies on AML and KYC. This demonstrates best professional practice by prioritizing regulatory adherence and risk mitigation. Specifically, it upholds the principles of Know Your Customer to prevent the bank from being used for illicit purposes and ensures compliance with reporting requirements for suspicious transactions, as mandated by PBOC directives. This proactive compliance check prevents potential legal penalties, reputational damage, and loss of operating licenses. Incorrect approaches analysis. One incorrect approach involves immediately approving the strategy based on its perceived profitability. This fails to acknowledge the paramount importance of regulatory compliance, potentially violating PBOC AML/KYC regulations. Such an oversight could lead to severe penalties, including fines and reputational damage, and demonstrates a disregard for the bank's legal obligations. Another incorrect approach is to dismiss the strategy outright without a proper review, solely due to the employee's inexperience. While caution is warranted, a blanket rejection stifles innovation and fails to provide constructive feedback or training opportunities. This approach neglects the bank's responsibility to foster a culture of compliance while encouraging responsible business development. It also misses an opportunity to educate the employee on the regulatory nuances. A third incorrect approach is to delegate the review solely to the business development team without involving the compliance department. This creates a significant conflict of interest, as the business development team may prioritize profit over regulatory adherence. This bypasses the essential checks and balances required by PBOC regulations and internal controls, increasing the risk of non-compliance. Professional reasoning. Professionals should adopt a risk-based approach to decision-making, integrating compliance considerations from the outset of any strategic initiative. This involves understanding the relevant regulatory landscape, In this case, PBOK AML/KYC regulations, identifying potential risks and implementing appropriate controls. When presented with new proposals, especially from less experienced staff, a structured review process involving relevant departments, particularly compliance, is crucial. This ensures that business objectives are pursued within a framework of legal and ethical conduct, fostering a sustainable and reputable financial institution. Question 10. System analysis indicates that a new corporate client seeking to open an account with Bank of China has provided documentation that appears to be in order at first glance. However, during the initial review, an employee notices that the stated source of funds for the business is unusually complex and involves multiple offshore entities, with limited transparency regarding the ultimate beneficial owners. The employee also observes that the projected transaction volume is significantly higher than typical for a business of this stated size and industry. What is the most appropriate course of action for the employee to take in accordance with Bank of China's regulatory framework for client onboarding and anti-money laundering? Option A. Escalate the concerns regarding the complex source of funds and unusual transaction projections to the compliance department for further review and request additional documentation from the client to clarify these aspects before proceeding with account opening. Option B. Proceed with opening the account as scheduled, assuming the provided documentation is sufficient and the client's explanation for the complexity is acceptable to meet the onboarding deadline. Option C. Inform the client that their account cannot be opened due to the complexity of their financial structure and the perceived risk, without seeking further clarification or escalation. Option D. Accept the client's verbal assurance that the offshore entities are legitimate and that the transaction volume is justified, and proceed with the account opening to avoid delaying business. The correct answer is A. Escalate the concerns regarding the complex source of funds and unusual transaction projections to the compliance department for further review and request additional documentation from the client to clarify these aspects before proceeding with account opening. Explanation. Scenario analysis. This scenario presents a common challenge in financial institutions, balancing the need for efficient client onboarding with the stringent requirements of anti-money laundering (AML) and Know Your Customer (KIC) regulations. The pressure to meet business targets can create a temptation to streamline processes at the expense of thorough due diligence. The professional challenge lies in upholding regulatory integrity and client protection while still facilitating legitimate business. This requires a nuanced understanding of risk assessment and the ability to apply regulatory principles in a practical, yet uncompromising manner. Correct approach analysis. The correct approach involves a risk-based assessment of the client's profile and transaction patterns. This aligns directly with the principles of the Bank of China's regulatory framework, which emphasizes a proportionate response to identified risks. By escalating the matter for further review and potentially requesting additional documentation based on the initial findings, the employee demonstrates adherence to the spirit and letter of AML/KYC regulations. This proactive stance ensures that potential illicit activities are identified and mitigated before they can impact the bank, thereby safeguarding its reputation and compliance status. This approach prioritizes regulatory compliance and risk management over immediate business expediency. Incorrect approach is analysis. Proceeding with the account opening without further investigation, despite the red flags, constitutes a direct violation of AML/KYC regulations. This failure to conduct adequate due diligence exposes the bank to significant risks, including financial penalties, reputational damage, and potential involvement in money laundering activities. Ethically, it represents a dereliction of duty to protect the financial system. Accepting the client's explanation at face value without independent verification, especially when presented with unusual transaction patterns, is also a failure of due diligence. While clients may provide explanations, regulatory compliance demands that these explanations be substantiated through appropriate checks and balances. This approach prioritizes client trust over regulatory scrutiny, which is a dangerous imbalance. Focusing solely on meeting the onboarding deadline without considering the implications of the red flags ignores the primary objective of KYC/AML procedures, which is risk mitigation. Regulatory frameworks are designed to prevent the bank from being used for illicit purposes, and deadlines should never supersede these fundamental obligations. This approach prioritizes operational efficiency over regulatory integrity. Professional reasoning. Professionals in banking must adopt a risk-aware mindset. When onboarding clients, the process should always begin with a thorough understanding of the client's business, source of funds, and expected transaction activity. Any deviation from the norm or presence of red flags should trigger a more intensive due diligence process. This involves escalating concerns to compliance departments, requesting supporting documentation, and potentially declining to onboard the client if risks cannot be adequately mitigated. The decision-making framework should prioritize regulatory compliance and risk management, ensuring that business objectives are pursued within a robust ethical and legal framework. Question 11. Stakeholder feedback indicates that a long-standing, high-value corporate client has recently engaged in a series of complex international transactions that appear unusual and deviate from their historical transaction profile. While the client's relationship manager believes these transactions are legitimate business activities, concerns have been raised internally about potential money laundering risks. What is the most appropriate course of action for the Bank of China to take in response to this situation? Option A. Escalate the matter to senior management for a decision without conducting any preliminary investigation or fact-finding. Option B. Immediately dismiss the concerns as minor administrative errors and assure the client that their business is valued, focusing on maintaining the relationship. Option C. Accept the relationship manager's assurance that the transactions are legitimate and continue to process them as usual, with a note to monitor future activity more closely. Option D. Initiate a thorough, independent review of the client's transaction patterns and supporting documentation to assess compliance with anti-money laundering and counter-terrorist financing regulations. The correct answer is B. Immediately dismiss the concerns as minor administrative errors and assure the client that their business is valued, focusing on maintaining the relationship. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client profitability and the bank's ethical obligations and regulatory compliance. The pressure to retain a high-value client can lead to a temptation to overlook or downplay potential compliance risks. Navigating this requires a strong understanding of the Bank of China's internal policies, relevant financial regulations, and ethical principles, demanding careful judgment to balance commercial interests with legal and ethical imperatives. Correct approach analysis. The correct approach prioritizes a thorough, independent review of the client's transaction patterns against established anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. This aligns with the Bank of China's duty of care and its commitment to upholding the integrity of the financial system. By initiating a detailed investigation, the bank demonstrates adherence to its Know Your Customer (KIC) obligations and its proactive stance on risk management, which is a cornerstone of regulatory compliance and best practice in the banking sector. This approach ensures that any potential illicit activities are identified and addressed promptly, safeguarding the bank from legal repercussions and reputational damage. Incorrect approaches analysis. One incorrect approach involves immediately accepting the client's explanation without independent verification. This fails to meet the bank's regulatory obligations under AML/CTF laws, which mandate robust due diligence and ongoing monitoring. It also represents a significant ethical lapse by prioritizing client retention over the prevention of financial crime. Another incorrect approach is to escalate the issue internally without conducting any preliminary investigation. While escalation is sometimes necessary, doing so without gathering basic facts or assessing the initial risk leaves decision-makers ill-equipped to make informed judgments and can lead to inefficient resource allocation or missed critical information. This approach bypasses essential risk assessment steps required by regulatory guidelines. A third incorrect approach is to dismiss the concerns as minor administrative errors without proper documentation or a formal review process. This is a direct violation of internal control procedures and regulatory expectations for suspicious activity reporting. It demonstrates a lack of diligence and a failure to take potential compliance risks seriously, exposing the bank to severe penalties. Professional reasoning. Professionals should adopt a structured decision-making process that begins with understanding the nature of the stakeholder feedback and its potential implications. This involves identifying the relevant regulatory framework, in this case, Bank of China's internal policies and applicable Chinese financial regulations concerning AML/CTF and ethical guidelines. The next step is to gather objective information through a preliminary assessment, followed by a more in-depth investigation if warranted. This process should involve consulting with compliance and legal departments to ensure all actions are aligned with regulatory requirements and internal policies. Transparency and thorough documentation are crucial throughout the process. Question 12. The efficiency study reveals a significant bottleneck in the loan approval process for small and medium-sized enterprises, SME, at Bank of China, leading to longer turnaround times and potential loss of business. Considering the regulatory framework of the People's Bank of China, PBOC, and the China Banking and Insurance Regulatory Commission, CBIRC, which of the following approaches best balances the need for improved efficiency with the imperative of sound risk management and regulatory compliance? Option A. Immediately reduce the number of required documentation and approval stages for all SME loan applications to accelerate the process, assuming that the majority of SMEs are low-risk clients. Option B. Implement a phased approach to streamline the loan application and approval workflow by leveraging technology for data verification and initial risk scoring, while ensuring that all credit decisions are still subject to review by experienced loan officers and adherence to established credit policies and regulatory guidelines. Option C. Focus on outsourcing a significant portion of the loan assessment and approval functions to third-party vendors without establishing stringent oversight mechanisms to quickly reduce internal processing times. Option D. Prioritize speed by allowing automated approval for all loan applications below a certain threshold, without requiring manual review or consideration of specific client risk factors beyond basic eligibility criteria. The correct answer is B. Implement a phased approach to streamline the loan application and approval workflow by leveraging technology for data verification and initial risk scoring, while ensuring that all credit decisions are still subject to review by experienced loan officers and adherence to established credit policies and regulatory guidelines. Explanation. The efficiency study reveals a significant bottleneck in the loan approval process for small and medium-sized enterprises, SME, at Bank of China. This scenario is professionally challenging because it directly impacts the bank's ability to serve a crucial segment of the economy, potentially affecting its market share and reputation. The pressure to improve efficiency must be balanced against the imperative to maintain robust risk management and compliance with regulatory requirements, particularly those concerning lending practices and customer due diligence. The correct approach involves a systematic, data-driven decision-making framework that prioritizes regulatory compliance and risk mitigation while seeking operational improvements. This approach represents best professional practice because it aligns with the Bank of China's overarching objectives of sound financial management, adherence to the People's Bank of China, PBOC, regulations on credit risk management and lending standards, and the China Banking and Insurance Regulatory Commission, CBIRC, guidelines on operational efficiency and customer service. It ensures that any proposed solutions are not only efficient but also legally sound and ethically responsible, safeguarding the bank and its stakeholders. An incorrect approach that focuses solely on speed without considering the implications for credit assessment would be professionally unacceptable. This would likely violate PBOC regulations, requiring thorough due diligence and risk appraisal before extending credit, potentially leading to increased non-performing loans and regulatory penalties. Another incorrect approach that involves bypassing established internal controls, compliance checks to expedite approvals, would be a direct breach of internal policies and potentially CBIRC directives on corporate governance and operational integrity. Such actions undermine the bank's control environment and expose it to significant legal and reputational risks. A third incorrect approach that prioritizes cost reduction over the quality of decision-making, perhaps by reducing the number of experienced personnel involved in loan assessments, would also be flawed. This could lead to a decline in the accuracy of risk assessments, contravening the spirit of prudent lending practices mandated by regulators, and increasing the likelihood of adverse outcomes. Professionals should employ a structured decision-making process that begins with a clear understanding of the problem and its root causes, as identified by the efficiency study. This should be followed by brainstorming potential solutions, evaluating each solution against key criteria, including regulatory compliance, risk appetite, operational feasibility, and strategic alignment. The chosen solution should then be implemented with robust monitoring and evaluation mechanisms to ensure its effectiveness and adherence to all applicable laws and guidelines. Question 13. The efficiency study reveals that the verification process for complex documentary credits in the trade finance department is significantly slower than industry benchmarks, leading to potential client dissatisfaction and increased operational costs. The department head is considering implementing a new automated verification system that promises to reduce processing time by 40%. However, the system has not been fully vetted by the bank's compliance or IT security departments, and the proposed implementation plan involves reducing the number of manual checks performed by senior compliance officers on high-risk transactions. Which of the following actions represents the most prudent and compliant approach to address this efficiency bottleneck? Option A. Authorize the Trade Finance Department to proceed with the automated system's implementation, with the understanding that any compliance issues that arise will be addressed reactively as they occur, and instruct the department to hire additional junior staff to handle the increased workload. Option B. Initiate a comprehensive review of the current documentary credit verification process to identify specific procedural inefficiencies. Consult with the compliance and IT security departments to assess the suitability and security of the proposed automated system, and develop a phased implementation plan that includes pilot testing and ongoing monitoring of both the system's performance and its compliance with all relevant PBOC and CBERC regulations. Option C. Immediately halt the proposed implementation of the automated system and instruct the Trade Finance Department to revert to the previous, albeit slower, verification procedures to avoid any potential compliance risks, without exploring alternative solutions. Option D. Proceed with the implementation of the new automated verification system after a brief internal review, while temporarily reassigning senior compliance officers to other tasks to expedite the rollout and reduce the manual checks on high-risk transactions. The correct answer is D. Proceed with the implementation of the new automated verification system after a brief internal review, while temporarily reassigning senior compliance officers to other tasks to expedite the rollout and reduce the manual checks on high-risk transactions. Explanation. The efficiency study reveals a significant bottleneck in the Bank of China's trade finance processing department, specifically concerning the verification of complex documentary credits. This scenario is professionally challenging because it requires balancing the need for operational efficiency and speed with the stringent regulatory requirements for anti-money laundering (AML) and Know Your Customer (KIC) compliance, as well as the bank's internal risk management policies. Misjudging the appropriate response could lead to regulatory penalties, reputational damage, and increased financial risk. The correct approach involves a multifaceted strategy that prioritizes regulatory adherence and robust risk mitigation, while seeking sustainable efficiency gains. This includes a thorough root cause analysis of the bottleneck, engaging with relevant compliance and risk management teams to understand the regulatory implications of any proposed changes, and implementing technology solutions that enhance verification accuracy and speed without compromising due diligence. This approach represents best professional practice because it aligns with the Bank of China's commitment to regulatory compliance, as mandated by the People's Bank of China, PBOC, regulations on financial institutions and anti-money laundering, and the China Banking and Insurance Regulatory Commission, CBERC, guidelines on operational risk management. It demonstrates a proactive and responsible method of addressing operational challenges by integrating compliance and risk considerations from the outset. An incorrect approach would be to solely focus on expediting the process by reducing the number of verification steps or relying on less experienced staff to handle complex cases. This would be a significant regulatory and ethical failure. Reducing verification steps directly contravenes the principles of thorough due diligence required by AML/KYC regulations, increasing the risk of facilitating illicit financial activities. Relying on less experienced staff for complex verification without adequate training and supervision violates internal risk management policies and potentially the CBERC guidelines on staff competency and operational oversight. Such an approach prioritizes short-term efficiency over long-term compliance and risk management, exposing the bank to severe penalties and reputational harm. Another incorrect approach would be to implement a new, unproven technology solution without adequate testing or consultation with compliance and IT security departments. This poses a risk of introducing new vulnerabilities or system failures that could compromise data integrity or operational continuity, potentially violating data protection regulations and internal IT security policies. Furthermore, it bypasses the crucial step of ensuring the technology aligns with existing regulatory frameworks for trade finance and AML/KYC. The professional decision-making process for similar situations should involve 1. Problem identification and scoping. Clearly define the operational issue and its potential impact. 2. Regulatory and risk assessment. Consult relevant internal policies, PBOC regulations, and CBIRC guidelines to understand the compliance and risk implications of the problem and any potential solutions. 3. Stakeholder consultation. Engage with compliance, risk management, legal, IT, and operational teams to gather diverse perspectives and ensure alignment. 4. Solution development and evaluation. Brainstorm and evaluate potential solutions, prioritizing those that enhance efficiency while upholding regulatory standards and risk appetite. 5. Implementation and monitoring. Implement chosen solutions with robust testing and ongoing monitoring to ensure effectiveness and compliance. Question 14. Quality control measures reveal that a client's account has triggered an automated alert for a series of unusually large and frequent international wire transfers, inconsistent with their known business profile. The bank's internal AML system flagged this activity as potentially suspicious. What is the most appropriate immediate course of action for the bank's compliance officer? Option A. Disregard the alert, assuming it is a system error or a false positive, and take no further action. Option B. Initiate an internal investigation to gather further details and assess the nature of the transactions before considering an external report. Option C. Immediately file a suspicious transaction report (STR) with the relevant regulatory authorities without further internal review. Option D. Contact the client directly to ask for clarification on the purpose of these wire transfers. The correct answer is B. Initiate an internal investigation to gather further details and assess the nature of the transactions before considering an external report. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the need to maintain client confidentiality and the regulatory obligation to report suspicious activities. The Bank of China, operating within the People's Republic of China, PRC, regulatory framework, must balance these competing interests. Failure to report could lead to severe penalties and reputational damage, while an incorrect or premature report could harm the client relationship and potentially lead to legal repercussions if unfounded. The professional must exercise sound judgment, relying on established procedures and a thorough understanding of anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. Correct approach analysis. The correct approach involves initiating an internal investigation based on the suspicious transaction report (STR) filed by the system. This aligns with the People's Bank of China (PBOC) regulations and guidelines concerning AML/CTF. The internal investigation allows the bank to gather more information, assess the legitimacy of the transaction, and determine if the initial suspicion is warranted. This process ensures that reporting is based on reasonable grounds, minimizing the risk of false positives while fulfilling the obligation to investigate and report potential illicit activities. This methodical approach upholds both client trust and regulatory compliance. Incorrect approaches analysis. One incorrect approach is to immediately escalate the transaction for external reporting without any internal review. This bypasses the bank's internal controls and investigative procedures, potentially leading to unnecessary reporting of legitimate transactions. This could violate internal bank policies and, in a broader sense, undermine the efficiency of the regulatory reporting system by flooding it with unsubstantiated alerts. It also risks damaging client relationships and the bank's reputation if the suspicion proves unfounded. Another incorrect approach is to ignore the system alert and take no action, assuming it is a false positive. This directly contravenes the regulatory obligation to investigate and report suspicious activities as mandated by PRC financial regulations. Such an action could result in significant penalties for the bank, including fines and sanctions, and could be interpreted as complicity in money laundering or terrorist financing if the transaction was indeed illicit. It demonstrates a severe lapse in professional duty and adherence to AML/CTF frameworks. A third incorrect approach is to contact the client directly to inquire about the transaction's nature before filing any report. This action compromises the integrity of the investigation and could tip off the client if they are involved in illicit activities, allowing them to further conceal their actions or destroy evidence. This violates the principle of maintaining confidentiality during an investigation and could hinder the effectiveness of law enforcement efforts, thereby failing to meet the spirit and letter of AML/CTF regulations. Professional reasoning. Professionals in banking must adopt a structured decision-making process when faced with suspicious activity alerts. This process should begin with understanding the internal policies and procedures for handling such alerts. Next, they should consult relevant regulatory guidelines, such as those issued by the PBOC, to understand their reporting obligations and the thresholds for suspicion. The core of the decision-making process involves a balanced assessment, gathering sufficient information through internal investigation to form a reasonable suspicion, while simultaneously protecting client confidentiality and avoiding premature actions that could compromise the investigation or regulatory compliance. If reasonable suspicion persists after internal review, the next step is to file a timely and accurate SDR. Question 15. Assessment of the appropriate course of action for a junior relationship manager presented with a loan request from a client whose financial viability is questioned by a senior colleague and who feels pressured to approve it. Option A. Inform the client that their loan application cannot be processed due to internal disagreements among staff. Option B. Conduct a thorough review of the client's financial statements, credit history, and business plan. Seek independent verification of critical information, and consult with the credit risk department or direct supervisor before making a decision. Option C. Decline the loan request outright without further investigation to avoid any potential risk or conflict with the senior colleague. Option D. Approve the loan immediately as recommended by the senior colleague to maintain a positive working relationship and meet performance targets. The correct answer is B. Conduct a thorough review of the client's financial statements, credit history, and business plan, seek independent verification of critical information, and consult with the credit risk department or direct supervisor before making a decision. Explanation. Scenario analysis. This scenario presents a professional challenge where a junior relationship manager, MS. Chen, faces pressure from a senior colleague to approve a loan for a client whose financial standing appears questionable. The challenge lies in balancing the need to maintain good working relationships and meet performance targets with the paramount duty to act in the best interests of the Bank of China and its depositors, adhering to sound lending principles and regulatory requirements. The pressure from a senior colleague introduces an element of potential coercion or undue influence, complicating the decision-making process. Correct approach analysis. The correct approach involves MS. Chen meticulously reviewing the client's financial statements, credit history, and business plan, seeking independent verification of key information, and consulting with her direct supervisor or the credit risk department. This aligns with the Bank of China's internal credit policies and the regulatory framework governing prudent lending practices. Specifically, it upholds the principles of due diligence, risk assessment, and responsible lending, which are fundamental to maintaining the financial stability of the institution and protecting customer assets. This approach demonstrates professional integrity, adherence to established procedures, and a commitment to sound financial judgment, thereby mitigating potential risks of non-performing loans and reputational damage. Incorrect approaches analysis. Approving the loan solely based on the senior colleague's recommendation without independent verification would be a significant regulatory and ethical failure. This bypasses essential risk assessment procedures, potentially violating internal credit policies and general banking regulations that mandate thorough due diligence. It also demonstrates a lack of professional judgment and an abdication of responsibility, prioritizing collegial pressure over fiduciary duties. Ignoring the client's financial discrepancies and approving the loan to avoid conflict with the senior colleague is also professionally unacceptable. This constitutes a failure to act in the best interests of the Bank of China and its stakeholders. It exposes the bank to undue credit risk and could lead to substantial financial losses if the loan defaults. Ethically, It represents a compromise of integrity and a disregard for the principles of sound financial management, escalating the issue immediately to higher management without first attempting to gather objective evidence or consult with the relevant internal departments, like credit risk, might be premature. While escalation is a valid step, doing so without a well-documented basis of concern, derived from a thorough review of the available information, could be perceived as an overreaction or an attempt to offload responsibility without due diligence. It might also strain interdepartmental relationships unnecessarily if the initial review was not sufficiently comprehensive. Professional reasoning. Professionals in MS.'s position should employ a structured decision-making framework that prioritizes objective analysis and adherence to established policies and regulations. This framework typically involves 1. Information gathering. Collect all relevant data, including financial statements, credit reports, and business plans. 2. Risk assessment. Analyze the gathered information to identify potential risks and their impact. 3. Policy and regulatory compliance. Ensure the proposed action aligns with internal policies and external regulations. 4. Consultation. Seek advice from supervisors, subject matter experts, or relevant departments. 5. Documentation. Maintain a clear record of the decision-making process and the rationale behind the final decision. 6. Escalation if necessary. If unresolved issues or significant risks persist, escalate the matter through appropriate channels with supporting evidence. Question 16. Comparative studies suggest that the successful integration of new anti-money laundering (AML) regulatory frameworks into large banking operations is a complex undertaking. Considering the Bank of China's commitment to robust compliance and operational efficiency, which of the following implementation strategies would best mitigate risks and ensure effective adherence to evolving AML requirements? Option A. Immediate, organization-wide deployment of all new AML systems and associated training materials, with a focus on rapid adoption across all branches and business units. Option B. A phased rollout of new AML systems and procedures, beginning with a pilot program in a select department to identify and address potential issues before a full-scale deployment, coupled with ongoing role-specific staff training. Option C. Assigning the entire responsibility for the implementation of new AML systems and procedures solely to the IT department, with minimal involvement from compliance and business operations teams. Option D. Prioritizing comprehensive, in-depth staff training on all aspects of the new AML regulations before any new systems or procedural changes are introduced. The correct answer is B. A phased rollout of new AML systems and procedures, beginning with a pilot program in a select department to identify and address potential issues before a full-scale deployment, coupled with ongoing role-specific staff training. Explanation. Scenario analysis. This scenario presents a professional challenge rooted in the implementation of new anti-money laundering (AML) regulations within a large financial institution like the Bank of China. The challenge lies in balancing the need for robust compliance with the practicalities of integrating new systems and training staff across diverse departments. The pressure to meet regulatory deadlines while minimizing disruption to daily operations requires careful strategic planning and execution. Misinterpretation or inadequate implementation can lead to significant regulatory penalties, reputational damage, and operational inefficiencies. Correct approach analysis. The correct approach emphasizes a phased, risk-based implementation strategy. This aligns with the principles of effective AML compliance, which prioritize resources towards high-risk areas. A pilot program allows for testing and refinement of new procedures and systems in a controlled environment before a full-scale rollout. This minimizes disruption, identifies potential issues early, and allows for iterative improvements based on real-world feedback. Training is integrated throughout the process, ensuring staff are equipped to handle the changes. This approach demonstrates a commitment to both regulatory adherence and operational efficiency, reflecting best professional practice in financial crime prevention. Incorrect approaches analysis. One incorrect approach focuses solely on immediate, blanket system deployment without adequate testing or phased rollout. This risks overwhelming staff, causing operational breakdowns, and failing to identify critical system flaws until after deployment, leading to potential breaches of AML regulations. It neglects the principle of proportionality and risk assessment inherent in effective compliance. Another incorrect approach prioritizes staff training over system readiness. While training is crucial, deploying inadequately tested systems or procedures can render the training ineffective or even misleading. This can lead to staff confusion and errors, undermining the intended compliance outcomes and potentially exposing the bank to regulatory scrutiny. A third incorrect approach involves delegating the entire implementation to the IT department without sufficient input or oversight from compliance and business units. Compliance is a shared responsibility. This siloed approach can result in systems that are technically sound, but do not adequately address the specific AML risks or operational workflows of the business units, leading to compliance gaps and inefficiencies. Professional reasoning. Professionals should approach regulatory implementation by first conducting a thorough risk assessment to identify key areas of concern. This should be followed by developing a detailed implementation plan that includes clear objectives, timelines, resource allocation, and key performance indicators. A phased rollout, starting with pilot programs, is often advisable to test and refine processes. Continuous communication and collaboration between compliance, IT, and business units are essential. Regular monitoring and evaluation of the implementation process, with mechanisms for feedback and adjustment, are critical to ensure ongoing effectiveness and adherence to regulatory requirements. Question 17. Benchmark analysis indicates that a long-standing and valuable client of the Bank of China expresses a strong desire to invest in a specific high-risk, unapproved financial product that is not currently offered by the bank due to internal risk assessment and regulatory restrictions. The client is insistent, citing personal research and a belief that this product will yield exceptional returns, and implies that their continued patronage depends on the bank facilitating this investment. The employee is aware that approving this request would violate established Bank of China policies and potentially contravene specific regulatory guidelines for financial institutions operating in China. Option A. Politely but firmly explain to the client that the requested product cannot be offered due to internal policies and regulatory restrictions, clearly outlining the reasons why it is not suitable or permissible for the bank to facilitate such an investment, and proactively suggest alternative approved investment products that align with the client's risk tolerance and financial goals. Option B. Proceed with facilitating the investment by finding a way to bypass internal approval processes, perhaps by suggesting the client open an account with an external entity that offers the product, while still maintaining the client's primary banking relationship with Bank of China. Option C. Agree to the client's request to invest in the unapproved product, assuring them that the bank will handle the necessary arrangements, and downplay the associated risks and regulatory implications to maintain client satisfaction. Option D. Inform the client that the bank cannot accommodate their request and advise them to seek investment opportunities elsewhere without providing any further explanation or offering alternative solutions. The correct answer is A. Politely but firmly explain to the client that the requested product cannot be offered due to internal policies and regulatory restrictions, clearly outlining the reasons why it is not suitable or permissible for the bank to facilitate such an investment, and proactively suggest alternative approved investment products that align with the client's risk tolerance and financial goals. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the Bank of China's internal policies and regulatory obligations. The employee is caught between maintaining a client relationship and adhering to compliance requirements. The pressure to meet performance targets can exacerbate this dilemma, potentially leading to compromised ethical judgment. Careful consideration of the long-term implications for both the client and the bank is paramount. Correct approach analysis. The correct approach involves prioritizing regulatory compliance and ethical conduct over immediate client satisfaction or personal performance metrics. This aligns with the Bank of China's commitment to operating within the legal framework and maintaining its reputation for integrity. By explaining the policy clearly and offering compliant alternatives, the employee upholds professional standards, protects the bank from potential regulatory breaches and reputational damage, and demonstrates a commitment to responsible financial advice. This approach fosters trust by showing transparency and a dedication to the client's best interests within the bounds of the law. Incorrect approaches analysis. One incorrect approach involves yielding to the client's request without proper due diligence or consideration of internal policies. This would constitute a failure to adhere to the Bank of China's operational guidelines and potentially violate regulatory requirements concerning product suitability and risk management. Could expose the bank to significant financial and legal penalties, as well as reputational harm. Another incorrect approach is to dismiss the client's request outright without offering any explanation or alternative solutions. This demonstrates a lack of client service and could damage the client relationship, potentially leading to the loss of business. Ethically, it fails to explore all avenues to assist the client within the established framework. A third incorrect approach is to attempt to circumvent the policy by subtly misrepresenting information or creating a workaround that technically adheres to the letter of the policy but violates its spirit. This is a form of dishonesty and a serious ethical breach that undermines the integrity of the banking system and the employee's professional standing. Professional reasoning. Professionals should adopt a decision-making process that begins with a thorough understanding of all relevant internal policies and external regulations. When faced with a conflict, the priority must always be compliance and ethical conduct. The next step is to clearly communicate these constraints to the client, explaining the rationale behind the policies. Finally, professionals should actively seek to find compliance solutions that still meet the client's underlying needs, demonstrating a commitment to both service and integrity. Question 18. Benchmark analysis indicates that a high net worth client who has previously expressed a conservative investment philosophy and a low tolerance for volatility is now requesting to invest a significant portion of their portfolio in a highly speculative emerging market technology stock. The client states they have read about the stock's potential for rapid growth and are eager to capitalize on it. As a financial advisor at Bank of China, what is the most appropriate course of action? Option A. Advise the client that their request is too risky and refuse to process the transaction, suggesting they seek advice elsewhere. Option B. Proceed with the investment as requested, but only after obtaining a signed disclaimer from the client acknowledging the high risk involved. Option C. Engage in a detailed discussion with the client to understand the motivation behind this sudden shift in investment interest. Explain the inherent risks of speculative investments and the potential impact on their overall portfolio, and propose alternative investment strategies that align with their stated risk tolerance and financial goals, while still offering exposure to growth opportunities. Option D. Immediately execute the client's requested trade to fulfill their instruction, as client instructions are paramount. The correct answer is C. Engage in a detailed discussion with the client to understand the motivation behind this sudden shift in investment interest, explain the inherent risks of speculative investments and the potential impact on their overall portfolio, and propose alternative investment strategies that align with their stated risk tolerance and financial goals, while still offering exposure to growth opportunities. Explanation. Scenario analysis. This scenario presents a common challenge in financial institutions where a client's stated investment objectives appear to conflict with their risk tolerance and financial capacity. The professional's duty is to act in the client's best interest, which requires a thorough understanding of their needs and a prudent recommendation, rather than simply fulfilling a client's potentially ill-informed request. The challenge lies in balancing client autonomy with the fiduciary responsibility to provide sound advice, especially when the proposed investment carries significant risk. Correct approach analysis. The correct approach demonstrates a commitment to the client's best interests, a core tenet of financial advisory ethics and regulatory frameworks governing financial institutions like the Bank of China. It involves a comprehensive assessment of the client's financial situation, risk tolerance, and investment objectives. By explaining the risks associated with the proposed investment and offering suitable alternatives that align with the client's profile, the professional upholds their fiduciary duty. This aligns with the principles of suitability and client protection mandated by financial regulations, ensuring that recommendations are appropriate and not driven by potential commission or other incentives. Bank of China's internal guidelines and relevant Chinese financial regulations would emphasize this client-centric approach. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's request without further due diligence. This fails to meet the regulatory requirement of suitability. It prioritizes the client's immediate instruction over their long-term financial well-being and exposes both the client and the institution to undue risk. Ethically, it is a dereliction of the advisor's duty to provide informed guidance. Another incorrect approach is to dismiss the client's request outright without understanding the underlying reasons or exploring alternatives. While the initial request may be unsuitable, a complete dismissal can alienate the client and fail to identify any legitimate, albeit perhaps misunderstood, investment goals. This lacks the professional courtesy and problem-solving approach expected and could lead to a loss of business and reputational damage. A third incorrect approach might be to push a product that offers higher commissions, even if it's only marginally suitable. This is a clear violation of ethical conduct and likely contravenes regulations against mis-selling and conflicts of interest. The focus shifts from the client's needs to the advisor's or institution's gain, which is unacceptable. Professional reasoning. Professionals in financial advisory roles must adopt a structured decision-making process. This begins with a thorough client discovery phase to understand their complete financial picture, risk appetite, and objectives. Next, evaluate potential investment products against these criteria, ensuring suitability. If a client's request is misaligned, the professional must educate the client on the risks and explore alternative solutions that meet their underlying needs. Transparency and clear communication are paramount throughout the process. This approach ensures compliance with regulatory requirements, upholds ethical standards, and builds long-term client trust. Question 19. Compliance review shows that a new directive from the People's Bank of China, PBOC, regarding enhanced customer due diligence, CDD, for cross-border transactions has been issued. The bank's existing CDD procedures are well established but predate this new directive. What is the most appropriate course of action for the bank to ensure full compliance with the new PBOC directive? Option A. Prioritize the implementation of the new directive by issuing a blanket memo to all staff stating that existing procedures must be followed but with increased vigilance, without specific procedural updates or targeted training. Option B. Rely on the existing CDD procedures, assuming they are sufficiently robust to cover the general principles of customer due diligence, and only make minor adjustments if specific issues arise during transaction processing. Option C. Seek external legal counsel to interpret the new directive and wait for their comprehensive guidance before making any changes to internal policies, even if it means delaying implementation beyond the directive's effective date. Option D. Immediately update the bank's internal CDD policies and procedures to explicitly incorporate the requirements of the new PBOC directive. Conduct targeted training for relevant staff on the updated procedures, and establish a monitoring mechanism to ensure ongoing adherence. The correct answer is D. Immediately update the bank's internal CDD policies and procedures to explicitly incorporate the requirements of the new PBOC directive. Conduct targeted training for relevant staff on the updated procedures, and establish a monitoring mechanism to ensure ongoing adherence. Explanation. Scenario analysis. This scenario presents a common challenge in regulatory compliance where a new, complex regulation is introduced. The difficulty lies in interpreting the nuances of the regulation and applying it to practical business operations, especially when there's a potential conflict with existing, well-established procedures. The pressure to maintain operational efficiency while ensuring full compliance necessitates a thorough and systematic approach. Correct approach analysis. The correct approach involves a multifaceted strategy that prioritizes understanding the regulation's intent and scope, engaging with relevant internal and external stakeholders, and developing clear, actionable implementation plans. This demonstrates best professional practice by ensuring that compliance is not merely a superficial adherence to rules, but a deeply integrated aspect of business operations. Specifically, this approach aligns with the Bank of China's commitment to robust internal controls and adherence to the People's Bank of China, PBOC, regulations, which emphasize proactive risk management and comprehensive compliance frameworks. It reflects a commitment to ethical conduct by prioritizing client protection and market integrity. Incorrect approaches analysis. One incorrect approach focuses solely on superficial documentation without understanding the underlying principles of the new regulation. This fails to address the spirit of the law and could lead to unintended breaches or misinterpretations, violating the PBOC emphasis on substantive compliance. Another incorrect approach prioritizes speed of implementation over accuracy and thoroughness, potentially leading to errors that could have significant regulatory consequences. This disregards the PBOC requirement for due diligence and careful risk assessment. A third incorrect approach relies on outdated internal policies without verifying their continued relevance under the new regulatory regime. This demonstrates a lack of proactive engagement with evolving compliance requirements and could result in non-compliance, exposing the bank to penalties and reputational damage. Professional reasoning. Professionals should adopt a structured decision-making process when faced with new regulations. This involves 1. Thoroughly researching and understanding the new regulatory requirements, including their objectives and scope. 2. Assessing the impact of the new regulation on existing business processes and identifying potential gaps. 3. Consulting with legal and compliance departments as well as relevant business units to ensure a comprehensive understanding and coordinated approach. 4. Developing and implementing clear, documented procedures and training programs to ensure effective adherence. 5. Establishing mechanisms for ongoing monitoring and review to adapt to any future changes or clarifications. Question 20. The efficiency study reveals that the Bank of China's current risk assessment framework, while robust for traditional banking operations, may not adequately capture the nuances and evolving nature of digital transformation initiatives. Considering the regulatory environment and the imperative for innovation, which of the following represents the most prudent and compliant approach to enhancing the bank's risk assessment capabilities? Option A. Develop a completely separate and independent risk assessment process exclusively for digital transformation projects, disconnected from the bank's core risk management system. Option B. Focus exclusively on identifying and mitigating known digital risks, while deferring the assessment of risks associated with pursuing new digital opportunities until they are fully realized. Option C. Maintain the current risk assessment framework, assuming it is sufficiently comprehensive to cover all potential risks, including those arising from digital transformation. Option D. Proactively recalibrate the existing risk assessment framework to explicitly integrate emerging digital risks and opportunities, ensuring a holistic and dynamic approach to risk management. The correct answer is D. Proactively recalibrate the existing risk assessment framework to explicitly integrate emerging digital risks and opportunities, ensuring a holistic and dynamic approach to risk management. Explanation. Scenario analysis. This scenario presents a professional challenge because the Bank of China is tasked with assessing the effectiveness of its risk assessment framework in a rapidly evolving digital landscape. The challenge lies in balancing the need for robust risk identification and mitigation with the imperative to innovate and leverage new technologies for competitive advantage. A failure to adapt the risk assessment process to account for emerging digital threats and opportunities could lead to significant financial losses, reputational damage, and regulatory noncompliance. Conversely, an overly cautious approach might stifle innovation and hinder the bank's ability to serve its customers effectively in the digital age. Careful judgment is required to ensure the risk assessment framework is both comprehensive and agile. Correct approach analysis. The correct approach involves a proactive and dynamic recalibration of the risk assessment framework to explicitly incorporate emerging digital risks and opportunities. This aligns with the Bank of China's regulatory obligations to maintain a sound risk management system, as stipulated by the People's Bank of China (PBOC) guidelines on operational risk management and cybersecurity. By integrating digital risk factors, such as data breaches, cyber attacks, and the risks associated with new digital products and services, into the existing framework, the bank demonstrates a commitment to forward-looking risk management. This approach ensures that potential threats are identified early, assessed appropriately, and mitigated through targeted controls, thereby safeguarding the bank's assets and reputation while enabling responsible digital transformation. Incorrect approach is analysis. One incorrect approach would be to maintain the existing risk assessment framework without significant modification, assuming it adequately covers all potential risks. This fails to acknowledge the unique and evolving nature of digital risks, potentially leaving the bank vulnerable to unforeseen threats. This approach violates the principle of continuous improvement in risk management and could be seen as a failure to comply with the spirit, if not the letter, of PBOC directives on adapting risk management to changing environments. Another incorrect approach would be to focus solely on mitigating known digital risks without considering the potential opportunities that digital innovation presents. This overly defensive stance can lead to missed business opportunities and a competitive disadvantage. While risk mitigation is crucial, a balanced approach that also assesses and manages the risks associated with pursuing digital opportunities is essential for sustainable growth. This approach might also be seen as a failure to align with broader national strategies promoting digital economy development. A third incorrect approach would be to implement a separate, siloed risk assessment process specifically for digital initiatives, disconnected from the bank's overall risk management framework. This fragmentation can lead to inconsistencies in risk assessment, a lack of holistic oversight, and potential gaps where risks are not adequately captured or managed across different parts of the organization. Effective risk management requires an integrated and comprehensive approach, not isolated processes. Professional reasoning. Professionals should adopt a decision-making framework that emphasizes continuous monitoring, adaptation, and integration. This involves 1. Staying abreast of emerging technological trends and their associated risks and opportunities. 2. Regularly reviewing and updating risk assessment methodologies to incorporate new risk categories and assessment criteria. 3. Fostering collaboration between risk management, IT, and business units to ensure a shared understanding of digital risks and opportunities. 4. Conducting scenario planning and stress testing to evaluate the resilience of the bank's systems and processes against potential digital disruptions. 5. Ensuring that risk appetite statements are updated to reflect the bank's strategic objectives in the digital space.